issue. Okay, we're good. I titled this particular webinar, Japan and the Coming Central Bank Reversal, a rather technical title. I suppose I could have titled it, I thought of it in the way in here, I could have said the Asian Sunset, or Japan and the Asian Sunset. What we're looking at, I think, is something that is beyond the scope of central bank and monetary policy. And it is indicated in that chart that we're going to start with this chart and just talk about it briefly. And then I'm going to go through some of the details and the particulars of what's going on in Japan and monetary policy. And perhaps, although I am by no means an expert or even terribly familiar with Japanese culture, I do have some knowledge of it, mainly from a friend of mine a good friend of mine who lived in Japan, speaks Japanese, lived in Japan for 16 years, recently came back within the past year, and we've had many, many discussions about Japan. He's in finance, the Japanese economy, Japanese culture, many other things. So David, if you're listening, which I assume you're not, most of my knowledge of Japan comes from this source. And I have read a great deal, but I've never actually been to Japan, although I have traveled throughout Asia, and I have lived in Asia for quite a number of years before the turn of the millennium. I have never been to Japan. Okay, so let's take a look here. So we're talking about central bank policy and what effects can central bank policy have on an economy, and what are its limits? That's really our discussion. And also, can incorrect central bank policy have a deleterious effect on an economy? And my answer for these questions would be that most assuredly there are many aspects, if not most aspects, to an economy that are beyond the reach of central bank policy. And of course that's true. Central bank policy primarily is focused on interest rates. It can't do much else. The things that we've heard from our Federal Reserve here in the United States about macro-prudential regulation is frankly just a bunch of nonsense. All they're really talking about is regulating to prevent future crises. Well, there's never been a crisis that's prevented by regulation because private enterprise and finance is far more creative, with far more reason to be creative than anything the regulators will ever be able to come up with. So the only thing you've ever been able to regulate against is prior crises. You can never regulate against future crises. And that will continue to be true as long as the species, meaning humans, do banking and finance and money. And as long as we're mortal, all these things are true. So central banks are limited to interest rate policy. The way central banks can be active, although it's as often negative as positive, is that a poor economy that is structurally inhibited cannot be improved by central bank policy. And we're going to look at that in terms of Japan very, very specifically. But one thing that is also true, another thing that's also true, is that an economy which is reasonable or even strong, but mostly reasonable, such as the United States the past decade or so, can be inhibited by exactly the things that the Fed does have control over. Interest rate policy and Ms. Yellen's macro-prudential regulation, if you take it in an economy-wide sense of regulation rather than something simply that the Fed will do. And that, I think, is the primary lesson of Japan for really the past 30 years, or at least the past 20 years. Now, this chart you're looking at here is annual GDP in Japan. And this is a half decade, that's in white with the blue underneath. The purple is a half decade moving average. And you can see, and if you run a decade average, you get a flatter line, of course. But if there is one thing that's fairly evident from this, it is the decline in GDP, in annual GDP. And what does that line most coincide with? Oddly enough, at least by all Keynesian analysis, and I think we've just seen in the past, 8 years here in the United States and around the world as well, but led by Ben Bernanke in the United States, a most fascinating. I've been watching a lot of the old Star Trek series, and of course, it's sort of the intellectual soul of the series is Commander Spock, and the emotional soul of the series is, of course, Captain Kirk. But one of Spock's favorite lines, of course, for people of a certain generation, is fascinating. So what we have seen in the United States and around the world is a fascinating exploration of the efficacy of Keynesian monetary policy. And as I've said many times in many contexts, we did not have to look to the United States to run this experiment. It's right here in front of us. When does this curve dip? It dips, oddly enough, as the rates go down. And when does it stay down? As the rates stay low. This is the base rate in Japan. Okay, the scale for the base rate is over here, right? So 1% is right here. This line right here is 1%. I'm going to use 1% sort of as the quantum limit. I know you've all heard this from me many times, the analogy with quantum mechanics from physics, and when the scale, the atomic scale, becomes very small, the rules of the game change. The rules of physics change, and that seems to be true in finance and interest rates relating to the human universe as well. When the interest rate stays permanently below 1%, it inhibits economic growth. It seems to be here. I mean, now, can we prove this? It's difficult. I can't prove it. I'm not an economist. But the coincidence is striking and permanent. And this is not, you could make a case, I suppose, in Japan that you have here, and this is the case that was made by everyone. When Bernanke and the Fed brought in zero rates and quantitative easing, I'm sure that they were well aware of the history of interest rates and Japan. I don't think they forgot. I don't think they didn't know. And two things are involved. One, I think they gave a discount to Japan because of supposed cultural or specific situations in Japan that were the cause of the decline in Japanese economic activity rather than the interest rate paradigm itself. And you can certainly make this case just prima facie. Competition. The issue with that, of course, is that Japan had long moved on by the mid and late 90s from a low-cost, low-wage export economy to a high value-added export economy. And the two things are quite different. And the Germans have shown clearly that a high value-added economy can sustain itself. in the face of increasing competition. Panasonic and Sony were once world beaters in consumer electronics. I did a search a little while ago on types of smartphones. The world-beating technology, pretty much invented by Apple and Steve Jobs, one of the truly consequential people in history, technical history, but I think history, period. And none of the brands, none of the leading brands, none of the best-selling brands are Japanese. The leading brands, at least, I can't answer for China. I think China has some of its own brands. But in the West and in much of the developed world, the Koreans and the Americans. Now that is not directly related to interest rate policy, but it's an example that high value-added products are driven by other factors than interest rates and economic conditions in the country. Okay, so this chart here would seem to illustrate a coincidence. Now, we've not established causal, and as I said, I'm not an economist. I have trouble establishing direct causal here. I don't get to go to my office and cogitate upon deep thoughts. Okay, so this is interest rates, annual GDP, and 5-year average. Let's look at another one, okay? Let's look at something, let's just bring this one up, okay? This is the Nikkei in white, the Japanese base rate, which unfortunately on Bloomberg does not go back before 92, in yellow, and dollar yen in green. So what do we see here? The curious coincidence is that given the delay, nonetheless, the higher the rate, and this rate goes back like this. So you're not seeing a blip here. The Japanese base rate was somewhere around this, all the way through this, somewhere around 4% all the way through this period right here. So the bubble in the Japanese Nikkei post-dated a very weak yen, 250, and here, and then the great fall. This is a Plaza Accord. This is the Plaza Accord around here, where the dollar would strengthen by international agreement. This is the great period of the Japanese fantasy of the Japanese are going to run the world, and one bit of central Tokyo was worth more than all of New York City and all this other stuff, all of which was a complete bubble fantasy. But the interesting things here are the almost reverse correlation between lower interest rates and the value of the Nikkei. If lower interest rates are supposed to promote economic growth, then it is certainly not reflected in this chart. You could make a much stronger case, and Mr. Abe has done so, Japan's prime minister, for the close correlation between the yen and the Nikkei, and the yen and the Japanese economy, because here, the average in the yen is on this chart right here. You could say through this period here, the average of the yen is probably, let's just make a quick run and say it's about 120. And if you make the average of the Nikkei somewhere around, around 15,000, maybe 16, 17,000, the variation there is within the same set of parameters. So with a export-driven economy, you have a closer relationship to the value of the yen, as you would expect. But again, like the prior chart, there is very little cause to have faith in zero interest rates or low interest rates as a source of economic prosperity. Okay, that's one we just put up. So let's look at another factor for where's my base rate? Okay, this is annual GDP. This is a similar chart to the one I just put up. Okay, we have here GDP in white, a half-decade average in GDP. This is annualized rates. We have the old Muktakam, it almost sounds Japanese, the base rate, and we have the Japanese yen. And again, you can see that if you're looking for an effect on GDP, this is the delay. Okay, now it doesn't always work, as you can see. Here, GDP and the yen come off, and interest rates come off. So if we're looking for a explanation for this blip up here, this about 5-year rise in GDP, you could say it was because the yen was coming down, delayed effect. You could say it's because interest rates are coming down, delayed effect, because they're both moving in the same direction. Again, we see the delay here. The yen goes up, and after a delay, GDP comes down, but interest rates are pretty much bottoming out here. So from this point on, we're largely losing the effect of interest rates because they don't change. Okay, we have GDP coming down here. I mean, we have yen coming down here. We have GDP going up and through the period. So you can see that there is a correlation. Now, between the yen, there's no correlation for interest rates. And the interesting fact here, of course, an additional one, is that there doesn't seem to be much correlation between interest rates and the currency. What that means, of course, is the Japanese have largely lost, because of the inability or their refusal or the fixation on zero rates, the Japanese have lost control of their currency. It's still true in the currency markets that the greatest correlation, although a little bit less so now, the greatest correlative for the strength of an economy, for the strength of a currency, excuse me, is the interest rate differential between that country and its trading partners. By surrendering the initiative in interest rates, Japan essentially has ceded the initiative in its currency. And as you can see, the currency has a far greater impact on GDP than does interest rates. So some of the questions here are, or maybe the basic question is, why did Japan persist in this particular policy? When the evidence goes back to 95, but I mean somewhere around here, or at least here, someone needed to look at the evidence and say, this is not working. Okay, let's try another comparison. I wanted to put up Japanese debt, but that's not really an interest rate policy, so I didn't bring it here. Here we have white is the Japanese base, monetary base. Interest rates in yellow and Japanese yen in green. So again, this period through here, once we hit about 2000, it becomes fairly clear that there's a much greater correlation, as you might expect, between the Japanese monetary base and interest rates. And the currency. So what is going on, especially in this period here? As the monetary base rises, the Japanese yen weakens. I don't think there's much surprise to that. So what is the Bank of Japan doing here? Well, the Bank of Japan is in the market buying every JGB it can get a hold of. It's essentially monetizing the entire debt of the Japanese government. So that is interest rate policy by other means. But let's look at, okay, this is the base rate. So, but the question, of course, and the purpose is GDP. I want to find the monetary base. Oh, here we go. No, monetary base, GDP. Hold on, I'm just looking for monetary base and GDP. Okay, where's my monetary GDP base rate? No, I don't want base rate, I want monetary base. Oh, did I not make, it's possible I didn't make this one. I made these charts in a rush this morning, I apologize. Okay, we're gonna have to use this one as a proxy. Sorry about that. Okay, but it'll work fine. What we have here is the, oh, that's the wrong one. Sorry, base rate. Okay, monetary base. Let's use this one, sorry. Okay, here we go. Sorry, my apologies. Okay. Okay, so what we have is monetary base with, we're gonna have to remember this one. Monetary base is here. So from 2000, about 2012, with the advent of Abe and also the quantitative easing on the part of the Japanese bank. So from 2012 up, huge increase in the monetary base, decline as per the election and elected policies of Abe, decline in the yen. Okay, so that's from 2012 on. Okay, so this we have here the annual GDP in white. The yen, which we're not so interested in, and the base rate. Now remember, from 2012 on, right here, just before the yen rose is when the monetary base in Japan skyrocketed. A continuation, not a continuation, but an exaggeration, a double down, if you will, not much of a verb, on the interest rate policies. It's a duplication of what the United States did, Ben Bernanke and the Fed, to bring down U.S. interest rates below what they, when the zero bound was reached, and they couldn't bring rates any lower. by fiat. So meaning order them lower. So what do? They went out and bought treasuries, drove treasury prices up, drove interest rates down. Well, the Japanese did the same thing. From about 2012 on, 1, 2, right here. Just before the yen rises, monetary base skyrockets. Huge peak, you saw it earlier. What was the effect on GDP? Nothing. We have here, as glaring, a set of proofs, both in the United States and in Japan, of the ineffectiveness of interest rate policy to affect economic growth, positive economic growth, to effectuate economic growth, positive economic growth near the zero bound. It doesn't work. We have seen it. We can do theorizing, because as far as I know, there haven't been any real any academic inquiry into this topic, as most academics tend to be Keynesians. But the evidence is here, and it will be investigated and formulated into economic theory, at least traditional, standard economic theory. Of course, my guess is, although I'm not that familiar with it, that the Austrians will have something to say about this already. So it is evident that neither zero interest rates or the improved zero interest rate policy from quantitative easing has any particular effect on positive effect on growth rates. Let's look at this. So the assumption we can make from this, from the evidence that we're looking at, is interest rate policy, as traditionally understood, the linear relationship, lower rates, more growth, higher rates, less growth, has a quantum limit. Below certain levels, I see that question. I will explain that in a second. Why the yen, the dollar yen rises, the value of the yen weakens when there's more, the Japanese buy JGBs. Okay. At this, let me just deal with this chart here, and then I'll be glad to answer that question the best I can anyway. This is a Japanese earnings. And the interesting thing about this is it's a monthly, the white are Japanese annualized earnings year on year. The turquoise line is a 5-year moving average. And this is the Japanese base rate. So the interesting thing about the chart and the relationship, again, coincidence at the moment. I don't have the proof, the academic connections to do this. But here, this is the zero bound right here on annualized interest rates. Somewheres around 2000, it dips below zero, and it does not return. Despite very low, relatively speaking, unemployment in Japan, there's no pressure on earnings. When, as we've discovered here in the United States in the past 8 years or past 9 years, inflation and other things are more a factor, at least as much a factor, of demand for goods and increases as it is for a monetarist push. Remember the Milton Friedman adage, inflation is always and everywhere a monetary phenomenon. That will now have to be modified. Because what has been proven for the past 8 years, both in Japan, in the United States, and in Europe and in England as well, but Europe more so, is that flooding an economy with liquidity does not necessarily produce inflation. It certainly doesn't produce growth. We've seen that. But it doesn't produce inflation. If there is no coincident demand, then prices do not rise. In a normal environment where demand is, if not static, at least healthy, it would produce inflation. But in an economy where demand and wages are restricted and restrained, and I don't mean, of course, by fiat, I mean by economic forces, it does not produce inflation. And this, although you could duplicate the same chart in the United States over a much shorter period, is the example of my favorite term, the quantum effect of interest rates on the economy. Now to the question. When the monetary base expands, I think two things happened with that. Let's bring up the monetary base. Here we go. This monetary base in white. Interest rates and the Japanese yen. I think two things were going on here. I think what we're seeing is more a coincidence than a effect. But it's hard to quantify. The reason it would go up is because if there's more money floating in a monetarist explanation, when there's more money floating around in an economy, each bit of it is worth less. Since you're not expanding, since when you simply increase, when you simply increase the amount of currency in circulation, then its base in the size of the economy has not grown. In other words, the economy hasn't grown, there's just more money applied to the same amount of GDP. So the value of each particular bit of money decreases. And it's the same thing here. So by and large, the traditional relationship between, did we lose the chart here? I just want to make sure we didn't. There we go. Okay, between the monetary base and the currency is that as you increase the monetary base, you devalue the particular level of the particular amount of each currency bit. And that's what we're seeing here. Now, this has proven to have, as we saw, the greatest effect on GDP. Because Japan is a heavily export-dependent country. So naturally, this would have much less effect in the United States because we're not so heavily dependent as a part of GDP. But Japan and Germany and other countries are very heavily dependent. So it's the same effect, the same exact effect as the monetarist inflation. More currency devalues the specific value of each bit of currency. We also had another factor, I think, through here that was not related specifically to the monetary base, but that was the policies of Prime Minister Abe when he came in, and he specifically targeted and spoke about it. And the market was perfectly willing to take him at his word, knowing that this would probably be what he'd do. So you have two factors here. It would be hard to disentangle the sort of the profit-driven motive of the currency markets running with Prime Minister Abe's first-elect and then first candidate and then Prime Minister policy to devalue the yen. So once he started talking about that, and it was very obvious he was going to get elected, the currency markets ran with it. But behind that, there is a real effect from the increase of the monetary base. So I think the two are in coincidence here. And again, it's the inflation effect, that more currency, stable, whatever it's based on, GDP, amount of goods as inflation. If you have 10 goods and you have $10, each one's worth $1. And if you have 10 goods and $30, then it's going to take each dollar 3 times to buy the same good. And it's the same effect here. I hope that was a reasonable explanation. Okay, so let's look at another chart here. Okay, nope, not that one, sorry. Sorry, the charts are a little confused here this morning. My apologies on that. It is the holiday season here. Let me bring that chart up again, hold on. I'm kind of forgetting which chart it was. Here we go. No, this one, yes, okay. Oh, you want, okay, yes, let me find that one. Here we go. Where's the yen? Here we go. Okay, this one. Let me explain this chart. And thank you for the input. It is always appreciated. In this chart, the white line is the monetary base in Japan. That's what happens when the GDP, when the Bank of Japan goes out and buys JGBs. Those are Japanese government bonds. They buy the bonds, they give the money to the holders, usually banks. The question is, what does the bank do with that money? Much of the time, and this is the reason why there is no relative effect on GDP, is because the bank gets the money but doesn't lend it out because nobody's asking for it. There's relatively limited demand. The green on this chart is the dollar yen. So as this goes up, the yen is weakening. So in this period right here, you're moving from 80, and this is the election of Prime Minister Abe, both the campaign and the election of Prime Minister Abe, when he said we're going to target the yen. And honestly, at this period right here, this long, curious period in here, when the Japanese yen is strengthening down to 80 for no particular reason. And then it stays down at 80. The Japanese economy is not doing well. Now, there is a reason which I will apply, and I'll tell you in a minute. But again, remember what I said earlier? So remember, green is Japanese dollar yen. So the higher the chart, the weaker the Japanese yen. The white line is the Japanese monetary base. The higher the line, the greater the monetary base. Remember I said one of the great unexplored factors of the Japanese interest rate policy for 20 years is that it cedes control of the yen. So what was going on here as the yen is from, say, about 2007, it looks like, on, then the yen is strengthening, which was terrible for the Japanese economy. As you can see, following the greatest correlation that we've come across in these charts for the Japanese GDP has been actually the yen rate, not the interest rate. Well, you get no change in interest rates, nothing happens. Okay. Interest rates have a relatively weak effect on the economy at the zero rates. For an economy like Japan, the yen, the trade effect, is stronger if interest rates are fixed or low, which is what they were here. So what was happening in this period here as the Japanese yen was strengthening? Well, of course, US rates were diving. And the US was starting quantitative easing. So relatively speaking, there is a reason for this, of course, and it was the change in interest rates. Well, why couldn't Japan counter it? Because Japan, until Abe decided to start, I'm assuming it was Abe, quantitative easing, because the Japanese had ceded control over their interest rates way back in 1995. So they couldn't do anything. And frankly, they didn't start even considering, apparently, quantitative easing until the US did it. So there is a sense of stultification in Japanese interest rate policy. What might have seemed like a good idea back here became a terrible idea here because they couldn't counter this. What did the ECB finally do after the US started raising? Well, they started lowering rates. So what else they started doing? They started doing quantitative easing. Finally, the Japanese did it here, and they got the effect that they wanted. And it had an effect on GDP. So the question next, and this was the title of this, and here I'm going to wait 1 second, then I'm going to go to the population chart. And this is the question which I can pose, but it's going to be difficult for me to answer. But I will try, of course. There is an empirical consensus. I don't mean that economists have decided this is true, although there have been many, there have been more than a few economists out there saying for a number of years that zero interest rates are inhibitory for an economy. The Fed, and frankly, the Fed probably owes its unequivocal ability at the moment to raise interest rates to Donald Trump and to the effect that Trump's election has had on US equities. With US equities at a record, it is impossible for the Fed to say the economy is not strong enough for an interest rate hike, so the Fed hikes. Let's take a look at the Nikkei. I think the Fed, although it hasn't said so, also realizes that the zero interest rate policy, especially the zero interest rate policy as typified by quantitative easing, is a failure. It does not do what it's supposed to do. And economists are going to have to come up with all these reasons and all these equations to explain why it doesn't do what it's supposed to do. But in fact, it doesn't. So the Fed has been desperate to raise rates, I would say, for 2 years. Last year, or actually this year, well, the year's almost over, they were prevented from doing what they had initially projected, 4 interest rate hikes, by various empirical circumstances. The collapse of equities in January and February, perhaps engendered by fear of that very same Fed rate increase policy. The fall of the Chinese yuan, which, by the way, is still falling, but the market has stopped paying attention to it, certainly as an indicator of trouble in the Chinese economy. And one of the reasons it's become less of an issue for the global economy and global markets is because the collapse in equities and equity currencies, the collapse in commodities has already taken place. The initial, it's been taking place for a couple of years, but it was much highlighted by the devaluation and the very careful planned devaluation of the Chinese yuan, because much of the excessive value of commodities, commodity stocks and everything else over the prior couple of years had been based on this ever rising commodity demand out of China. If the Chinese are devaluing their currency at a very pronounced, prolonged, and relatively, actually not a rapid rate, a very stable devaluation rate, then clearly China is not going to be drawing in huge amounts of ever increasing amounts of commodities, and certainly not at the exaggeratedly high commodity values to which the markets are driven by speculation on that very erroneous demand picture out of China. Well, that's already taken place. So although the Chinese are continuing to devalue their currency, the indication that it means for commodities and emerging markets has already taken place. So unless the Chinese economy starts to show some much more pronounced signs of failure in its own statistics, the markets are not paying attention to the devaluation of the ongoing devaluation of the yuan. Okay, so back to the use of interest rates. So we have an empirical fact which the Fed seems to have taken recognition of. Now, I mean, another reason behind this, but it's the same reason really, is that sooner or later a recession is going to hit the United States. And since rates at the zero bound or driven below, and the Europeans have this as well with all their zero rates, do not affect economic growth in a positive sense, then they're not going to work if there's a recession. So when the United States hits a recession, and it will, if rates are still 1 or 1.5% or lower, what is the Fed going to do? Well, it can drive rates to -0 or to -0.5% or -1%, but that doesn't do any good. That's what the past 4 years have told us. That doesn't sponsor economic growth. In fact, it probably makes things considerably worse, because it means these central bank authorities think the economy is in very poor shape, and because businesses can't plan. And what have we seen what they do? They buy back stocks, they pay dividends, and they bank the money. They don't invest it, because they can't judge the course of future interest rates. It acts as an inhibitor on economic growth. So for the Fed, which seems to realize this, it's desperate to get rates back up for the next recession. Aside from the fact that rates don't work, all right, they're not going to admit that. But they need it up for the next recession, because otherwise they'll have nothing to do. Because if you reduce rates from 1 to half, you don't get anything. But if you reduce them from 3 to 2, you get something. So this seems to have finally dawned on the Fed after their experiment that they need to do this. Even the ECB seems to be starting in their very gradual way, letting the markets know that we're headed there too. That's how I interpret the last meeting of the ECB. We're reducing the amount per month of quantitative easing purchases in the market, but we're increasing the period by 3 months. That, to me, cannot be interpreted in any other way except, well, from a bureaucratic point of view, that they've got a split board, but that recognition is seeping in of the quantitative effect, the quantitative limits of interest rate policy, and that sooner rather than later, the ECB is going to reverse course as the Fed has. Not because the economy has strengthened, not because the policy has worked, but precisely the opposite, because the policy hasn't worked. Will, the title of, and that's what I call the coming central bank reversal. Will Japan follow suit? I have not seen any indication. Well, actually, there has been some talk from the ECB, from the Bank of Japan, all talk about this. And I think what we're going to see sometime in 2017 is the acknowledgement. It'll have to be by signs and wonders and not by words. You're not going to hear from the Fed, from Janet Yellen's Fed, an explication of the quantum effect of interest rates at the zero bound. You're not going to hear that. They are not going to come out and say this policy didn't really work. And in fact, it's probably a negative. But they are going to change policy, which tells you that's what's going on. And they're going to say the economy's strong enough. GDP in the United States is running at 2%, maybe 2.1%, something like that. How does that qualify as a economic growth rate that requires restraining? Wages are rising barely at a little more than inflation. How does that qualify as an incipient inflation threat into the future? It doesn't. Same is true in Europe. Same is true in Japan. So it's not the economic, this is my thesis, it's not the economic conditions that are permitting central banks, starting with the United States, to return to a more normal rate environment. Now, the Fed has always said that it wanted to, almost always, that it wanted to normalize rates. And the only way to interpret normalized rates, which is what they mean, is higher rates. So I think from the very beginning, the Fed has recognized that this needs to be a temporary policy. The box they got themselves in is that they required standard economic criteria, meaning a substantially more robust economy, higher wage increases and inflation, the standard economic criteria to enable them to start ending the zero rate policy. The problem is they didn't realize just to what degree, I think, that the zero rate policy itself became inhibitory. But they acknowledged that it would have to end from the beginning. If you look at this chart for Japanese interest rates, there is zero, no pun intended, recognition in the Bank of Japan that for 20 years, this policy needs to end. Because what? Because it doesn't work. It's almost as if the Japanese had to be enabled. Now, as I said, I am not that familiar with Japanese bureaucratic culture, but it certainly seems to me that this chart requires an end in itself. Let's look at one more chart, and then we will end our production for today. This is the context in which Japanese GDP and the economy and the BOJ and policy exists. The curve is Japanese population. 2016 is right about here, okay? And this is the projection out into the future. This is the chart which tells you more about, now that is not a growth rate in the yellow is Japanese GDP, the number, not the growth rate. You could still have a strong growth rate. You don't, but you could, even with a relatively static GDP. It would be well, that's not possible. You would have a, let me rephrase that one. GDP is a product of the number of people, how much they work, and their productivity. The growth rate is a product of the same thing, but with much more of an emphasis on productivity. So this is an indicator of the first way of looking at GDP. That's the size of the Japanese economy. And you can see that although it's a very rough equivalent, it is tied closely to the number of people actually out there in the population and working. And if you are looking for, and this has been my thesis for, remember, the Japanese GDP began to stagnate right around here. Not quite, but right around here. So if you're looking for an effect for an economy, and it's long been my contention that the inability of the Japanese to generate their prior economic growth numbers have more to do with the stagnation and current decline of their population than almost anything else. And this is a warning to all the countries of Europe with minimal birth rates, and perhaps to economists who need to consider this in their equations as well. So to conclude, I think the Japanese central bank will reverse its zero-rate policy and adopt some of the unstated prescriptions of the Fed and perhaps the ECB that negative rates are a drag on economic growth. It does not answer the problems of this chart, meaning a declining population, but it should improve the economic performance of Japan. Okay, folks, I thank you very much for listening. I hope this has been useful, perhaps entertaining and instructive. I am not sure if we're going to do any more webinars this year. I'll talk about it with FX Street. I thank them for their facilities and also their sponsorship, of course. If not, we will certainly renew in the new year. Again, thank you all very much for attending. I hope it was instructive. I will put my email up there, and you can certainly send me any emails at work, and I'll be glad to answer them. Again, thank you all very much, and everybody have a great day.